Personal loans. A personal loan is unsecured money, which means the lender hands it over with nothing of yours held as collateral. There's nothing to repossess. That single fact sets the price. When a lender can't take your car or your house, the only thing standing between them and a loss is your credit history. So the risk gets priced into the interest rate. Strong credit, low rate. Thin credit file, high rate. Identical loan, wildly different cost. The structure is an installment loan. Fixed amount, fixed term, fixed monthly payment, and an end date that you can circle on a calendar. That predictability is the entire advantage over a credit card. Then there's the number almost nobody checks. The interest rate and the APR are not the same thing. The rate is only the interest. The APR includes the origination fee, which is usually taken out of the money before it reaches you. Borrow $10,000 with a 5% origination fee, and $9,500 lands in your account, but you pay interest on the full 10. That fee is not chimp change. Read the APR, not the rate. Credit cards. A credit card is a revolving line of credit, which is a loan that refills itself every time you pay it down. There is no end date. That's the defining feature. It's the entire danger. An installment cost has a finished line written into the contract. Revolving credit is built to be permanent. Here's what the statement doesn't spell out. Carry a balance, and interest typically compounds daily rather than monthly. The balance grows a little every night while you sleep. But there's a door most people walk straight past. Pay the statement balance in full each month, and the grace period means you're charged no interest at all on purchases. Used that way, a credit card is a short-term loan that costs nothing. Cash advances get no grace period. Interest starts the moment the money leaves the machine, usually at a higher rate, usually with a fee attached. And the minimum payment is the real mechanism. It's calculated to keep the account healthy, not to get you out of it. On a large balance, most of that payment disappears into interest, and the principal barely moves. Pay the minimum and you're not climbing. You're just hanging there. Auto loans. An auto loan is secured debt, which means the vehicle is the collateral. Fall far enough behind, and the lender doesn't take you to court. They take the car. That collateral is exactly why auto rates sit well below personal loan rates. The lender has something to grab. But the asset works against you here in a way property doesn't. A new vehicle loses a significant share of its value in the first year and keeps sliding after that. Your loan balance falls in a straight line. The vehicle's value falls on a curve. For a stretch of that loan, the two lines cross the wrong way, and you owe more than the thing is worth. That's negative equity, and the industry calls it being underwater. Longer terms make it worse. 72 or 84 months lowers the monthly payment while keeping you underwater for years longer. Then comes the move that quietly wrecks people, trading in a vehicle you still owe on and rolling the leftover balance into the next loan. Now you're financing two vehicles and driving one. That's monkey business, wearing a monthly payment. Mortgages. A mortgage is a long-term secured loan with the property as collateral, and it runs on a schedule called amortization. Amortization is the most misunderstood concept in personal finance. So here it is. Every payment splits between interest and principal, but the split isn't even, and it doesn't start fair. Interest is charged on what you still owe, and at the beginning, you owe all of it. So in the early years of a 30-year mortgage, the large majority of each payment goes to interest, and only a sliver touches the balance. You don't reach the halfway point where equal amounts go to each until you're well past a decade in. That's why across 30 years, total interest at a typical rate can rival or exceed the amount you originally borrowed. You aren't only buying the house, you're buying the money. The payment usually includes escrow too, which holds property taxes and homeowners insurance. That's how a payment rises on a fixed-rate loan, and lenders approve you on your debt-to-income ratio, not your salary. What you earn matters less than what you already owe. Home equity. Equity is the portion of the property you actually own, and once there's enough of it, lenders will let you borrow against it. Two versions. A home equity loan hands you a lump sum at a fixed rate. A HELOC is a revolving line you draw from as needed, usually at a variable rate. Both are second liens, meaning a second lender now holds a legal claim to your home, sitting behind your original mortgage. The rates look wonderful next to unsecured borrowing, and there's a reason for that. You've converted debt backed by nothing into debt backed by the roof over your head. The HELOC carries a structural detail people miss entirely. There's a draw period, often around 10 years, where payments can be interest only. Then the repayment period begins, and the payment jumps as principal finally enters the math. Nothing about your income changes on that date. The payment changes anyway. Borrowing against your home to clear a credit card doesn't erase the balance. It relocates it onto the branch you're standing on. Refinancing. Refinancing replaces an existing loan with a new one, and there are two kinds doing completely different jobs. Rate and term refinancing swaps your loan for one with a better rate or a better length, and the balance stays roughly the same. Cash out refinancing replaces it with a larger loan and hands you the difference, converting equity into spendable money and a bigger balance. Both carry closing costs, which is why one calculation decides everything. Divide the total cost of the refinance by the monthly savings, and you get the break-even point in months. Stay past it, and you come out ahead. Move or refinance again before it, and you paid for nothing. Here's the part the lower payment hides. Refinancing a mortgage you've already paid on for 8 years into a fresh 30-year term drops you back to the front of the amortization schedule, where payments are mostly interest all over again. Lower payment, more years, frequently more total interest. The monthly number went down. The price of the money went up. Student loans. Student loans split into two categories that share a name and almost nothing else. Federal loans come from the government with fixed rates and a set of protections built into them. Income-driven repayment plans, deferment and forbearance options, and forgiveness programs tied to certain public service work. Private loans come from banks and lenders, get priced on your credit like any other loan, and carry none of those federal protections by default. The mechanism that catches people is capitalization, unpaid interest that accrues while you're in school or during a pause in payments can be added to the principal. From that point on, you're paying interest on interest. A balance can be larger than the amount borrowed before the first payment is ever made. Student debt is also unusually difficult to discharge in bankruptcy compared with nearly every other loan on this list, which is why it follows people for decades. Federal repayment rules shift with policy, so check the current terms than what someone told you 3 years ago. One word, two very different animals. Buy now, pay later. Every one of those checkout buttons is a loan, even though the word almost never appears on the screen. The standard structure splits a purchase into 4 payments across roughly 6 weeks, usually with no interest if you pay on schedule. Approval takes seconds and often involves no hard credit check, which is precisely why it converts so well at checkout. The design does something specific to your judgment. It reframes the price. 120 becomes 4 payments of 30, and 30 is small enough that the part of your brain built for weighing consequences never fully wakes up. The revenue comes from 2 directions. Merchants pay a fee for a higher conversion rate, and late fees come from you. The real complication is stacking. Nothing prevents several of these plans running simultaneously across different providers, each invisible to the others, all pulling from the same account on different dates. Credit bureau reporting varies by provider and keeps changing, so those balances can be difficult for any lender to see at all. 4 easy payments still means you split the banana 4 ways and ate it today. Promotional Financing. 0% offers come in two versions that look identical in the advertisement and behave nothing alike. True 0% APR means the interest is waived for the promotional window. Pay the balance across that period, and the money genuinely cost you nothing. Deferred interest is the other one, and it's common in retail and medical financing. Interest is not waived. It accrues quietly in the background the entire time, and it's only forgiven if you clear the full balance before the window closes. Miss it by 1 month with a small balance remaining, and you aren't charged interest on what's left. You're charged all of the interest that accumulated on the entire original amount, from day one, applied retroactively. 23 months of perfect payments, 1 month short, and the bill arrives as though the promotion never existed. The two offers use nearly identical wording on the sign. The difference lies in the terms. Under a heading almost nobody opens. That's not a free banana. That's a banana with a timer on it. Payday loans. A payday loan is a small, short-term loan due on your next pay date, and it's priced with a flat fee instead of a rate. That fee framing is what obscures the cost. 15 on every 100 borrowed sounds modest. Spread across 2 weeks and annualized, the APR lands in the triple digits. But the structure matters more than the price. The entire amount comes due at once rather than in installments, and someone who needed money 2 weeks ago usually can't produce the full balance plus the fee on payday. So the loan is rolled over, another fee attaches, and the clock restarts. Title loans run the same play with your vehicle's title as collateral. Falling behind costs more than money here. It costs the transportation you need to keep earning. Credit unions frequently offer small dollar loans at a fraction of the cost, and many employers now provide earned wage access. Both are worth checking before the fee clock starts. The fee isn't what does the damage. The rollover is. Debt consolidation. One consolidation loan is one new loan that pays off several existing ones, leaving a single payment behind. The mechanism is arithmetic. If the new rate is lower than the weighted average of what you're carrying, you pay less for the same money. That part is real, and against high-rate revolving balances, it can save a serious amount. Two details decide whether it actually works. The first is the term. Lowering the monthly payment by stretching 3 years of debt across 6 can increase the total interest even at a lower rate. The payment shrank, the cost grew. The second is behavior, and lenders understand this better than borrowers do. Paying off cards with a consolidation loan leaves those cards sitting at zero, fully available, and extremely easy to use again. Now, the original balances are back with a consolidation loan underneath them. Notice what a secured consolidation does too. It converts debt backed by nothing into debt attached to your house or your car. Consolidation reorganizes your debt. It doesn't remove it, and the monkey rides just as comfortably on one loan as on 5. Business loans. Business financing is personal borrowing in a suit, with one clause that changes everything: the personal guarantee. Most business lending requires the owner to personally guarantee the debt, which means the limited liability protecting you evaporates for that loan. The business borrows. You repay from personal assets if it can't. Government-backed programs work by reducing the lender's risk rather than yours. A guarantee agency absorbs part of the loss if the loan fails, which is why those loans come with longer terms and lower rates than a bank would offer on its own. The paperwork is heavier for exactly that reason. Then there's the product that isn't technically a loan at all. A merchant cash advance buys a slice of your future sales and prices it with a factor rate instead of an APR. A factor of 1.3 means repaying $13,000 on 10. That sounds flat until you notice the repayment window is months rather than years, which pushes the effective annual cost far above anything a bank would quote. A factor rate is not an interest rate. That distinction has closed more businesses than bad products have. Retirement loans. Many workplace retirement plans let you borrow against your own balance, and on the surface, it's the best deal on this list. No credit check, and the interest you pay goes back into your own account. You're the lender, you're also the borrower. It sounds like money changing pockets. 3 mechanics complicate that. The money you pull out is sitting outside the market for the life of the loan. Whatever the market does over those years, your borrowed portion doesn't participate. And that missed growth is the real cost. It's invisible because it never appears as a fee. You repay with money that's already been taxed into an account that gets taxed again on the way out in most plan types. And the timing risk is the one that actually hurts. Leave the job, by choice or otherwise, and the outstanding balance typically becomes due on a short deadline. If it isn't repaid, it can be treated as a distribution with income tax and, depending on your age, an additional penalty attached. You lost the job and received a tax bill for the privilege. Raiding your own banana stash still leaves you short in winter. Margin loans. A margin loan lets you borrow against investments you already own, with the portfolio itself serving as collateral. The appeal is liquidity without selling, which means no sale and no immediate tax event. Rates often sit below unsecured borrowing because the collateral is liquid. The lender can convert it to cash instantly. That last part is the entire risk. The loan is tied to the value of collateral that moves every single day. If the portfolio falls far enough, the account breaches its required ratio and triggers a margin call, which is a demand to add money or reduce the loan. Here's the clause worth knowing before signing. Brokerages generally reserve the right to sell your holdings to satisfy that call without contacting you first, and to choose which positions get sold. So the forced sale happens at the worst possible moment, at the bottom, in the assets you'd least want to release, on someone else's decision. Every other loan on this list gives you time to react. This one can act while you're asleep. Reverse mortgages. A reverse mortgage runs a normal mortgage backward. Instead of paying a lender every month to build equity, an older homeowner converts existing equity into money coming in. The main program is limited to homeowners past a set age, typically 62, and the amount available depends on age, home value, and rates. No monthly mortgage is required. That's the appeal, and it's real. But interest and fees don't vanish because nothing is being paid. They accrue and attach to the balance. This loan grows over time instead of shrinking, which is the mirror image of everything else in this script. 3 obligations keep it in good standing: property taxes, homeowners insurance, and maintenance. Falling behind on any of them can make the full balance due, and that's the most common way these end badly. The loan comes due when the last borrower sells, moves out long-term, or passes away, and heirs settle it by repaying or selling the home. Federally insured versions are non-recourse, meaning the amount owed at sale generally can't exceed what the home is worth. The vine runs the other direction. Everything else about gravity still applies.